Welcome to the Deep Dive, the show where we tackle heaps of information and pull out just the real gems of knowledge for you. We want to make complex stuff clear and honestly pretty interesting.
Exactly. We're cutting through the noise to get to what really matters.
And today we're diving into something that might sound a bit dry at first, other information and supplementary information. All that stuff you find alongside audited financial statements.
Right. It sounds technical, but understanding it is key to grasping the full picture a company is presenting. It's about trust and transparency, really.
Totally. So our mission today is to break down what these terms mean, why they're actually important, and crucially, what auditors have to do about them. Let's jump right in. Okay, so picture this. You've got a company's annual report in your hands. You flip through the glossy pages, the CEO's letter, then you get to the core financials, the audited stuff.
The balance sheet, income statement, cash flows.
Yeah,
The usual suspects.
exactly. But those audited statements, they're almost never just floating there alone, are they? They're usually part of a much bigger document.
That's right. Like an annual report to shareholders or maybe a report from a charity or something.
So besides those core audited numbers, what other kinds of information, what other stories might you find packed in there?
Well, that's where other information comes in. It's basically financial and non-financial info included in a document that also contains audited financial statements and the auditor's report, but it's not part of those core statements.
Okay, like what specifically? Give us some examples.
Sure, think about things like a report from management talking about how operations went, or maybe financial summaries or highlights, employment data, how many people work there.
Planned capital expenditures too, like what they plan to build or buy.
Yep. That's a common one.
Mhm.
Financial ratios, names of the officers and directors, even selected quarterly data sometimes. It's all that context surrounding the official numbers.
Gotcha. But it's also important to know what isn't included in this other information category, right?
Absolutely crucial. We're not talking about press releases the company puts out separately or the cover letter attached to the report.
Or stuff from analyst briefings or just general info on the company's website.
Exactly. Those are outside the scope of what we mean by other information accompanying the audited financials. And that distinction matters because it defines the auditor's responsibilities.
Okay, so what is the auditor's responsibility here? Do they have to audit all this extra stuff?
Generally, no. The auditor is not typically responsible for figuring out if all that other information is perfectly stated or correct. Their main job, their audit engagement, is focused squarely on the financial statements themselves.
But. I sense a but coming.
But, and this is a big one, they are required to read it. They can't just ignore it.
Okay, now that's interesting. If they aren't auditing it, why the requirement to read it? What's the point?
It boils down to credibility. The credibility of the audited financial statements could be seriously undermined if there's a material inconsistency between those statements and the other information.
Ah, okay. So even though the other information isn't audited, if it flat out contradicts the audited numbers, it makes the whole package look unreliable.
Precisely. Imagine the audited numbers are the verified facts, and the other information is the story the company tells around those facts. If the story clashes badly with the facts, it raises a huge red flag.
It could mislead users, even if the core numbers are technically right.
Exactly. Users rely on the whole report, so the auditor reads the other information to protect the integrity and context of their audited opinion.
So let's talk about those clashes. What's a material inconsistency?
That's when the other information directly contradicts information in the audited financial statements. It's a head-to-head conflict.
Can you give us a clear example?
Sure. Let's say the other information includes a management discussion that states revenue for year one was $20 million.
Okay.
But then you look at the audited income statement, and it clearly shows revenue for year one was only $5 million.
Wow, okay, that's not a small difference. That's a material inconsistency.
Bingo. It's a direct, factual contradiction on a significant item.
So what happens then? What does the auditor do when they spot something like that? They can't just ignore it, right?
Absolutely not. Their first job is to investigate. They need to determine if the audited financial statements are wrong or if the other information needs to be revised.
So figure out which source needs fixing.
Right. And while doing that, they also need to think about whether this inconsistency changes their overall understanding of the company. Maybe it points to a bigger issue they missed.
And what if they figure out, say, the other information is definitely wrong, but management digs in their heels and refuses to correct it?
Okay, now we get into consequences. If the financial statements need fixing and management refuses, the auditor has to modify their audit opinion. That could mean a qualified opinion or even an adverse or disclaimer of opinion, big red flags for users.
Right, that directly impacts the main audit report. But what if the financial statements are fine and it's the other information that needs fixing and management still refuses?
In that case, the auditor first has to communicate the issue with those charged with governance. Think the board of directors or the audit committee, the people at the top.
Okay, they escalate it. Then what?
Then the auditor has a few options. They might need to describe the uncorrected material inconsistency in their audit report, usually in that other information section we'll talk about.
So they call it out publicly.
Yes, or they might consider withholding the auditor's report altogether. Or in really serious situations, they might even withdraw from the engagement entirely and probably consult with their lawyers.
Wow, okay, so they have some real leverage to push for corrections.
They do. Their reputation and the integrity of the audit are on the line.
Now, you mentioned another potential issue, material misstatement of fact. How's that different from a material inconsistency?
Good question. A material misstatement of fact is an error in the other information that's not directly related to the numbers or data in the audited financial statements. It's a factual mistake about something else.
Okay, so not a direct contradiction of the financials, but still wrong.
Exactly. Maybe the other information talks about the company opening a new factory last year, but the auditor knows through other audit work that the factory opening was actually delayed until this year. That's a misstatement of fact, but it doesn't directly clash with, say, the revenue number.
Got it. So what's the process if the auditor spots one of those?
Pretty similar process, actually. First, they discuss it with management. If management agrees it's wrong and fixes it, great.
And if they don't?
If management refuses, the auditor might suggest they consult with a qualified third party, like the company's lawyers, to get their take on it. The auditor considers that advice.
And if it's still not corrected? And the auditor is convinced it's a material misstatement.
Then, just like with an inconsistency, they notify those charged with governance, and they likely need to describe the issue in the other information section of their audit report.
So speaking of the audit report, how does the auditor actually tell the world about this other information and their limited responsibility for it?
Right. For non-issuers, so private companies, primarily the auditor adds a separate section to their standard audit report. It's usually clearly labeled something like other information.
And what does that section say? Because they aren't giving an opinion on it, right?
Correct. No opinion. The language is very specific and carefully chosen. It typically states, first, that management is responsible for preparing the other information.
Okay. Puts the onus on them?
Yes. Then it clarifies that the auditor's opinion on the financial statements does not cover the other information, and importantly, that the auditor does not express any form of opinion or assurance on it.
So crystal clear boundaries.
Very clear. Then it explains the auditor's actual responsibility, which is to read the other information and consider if there are material inconsistencies or apparent material misstatements of fact based on the work they did for the main audit.
And crucially,
It states that if the auditor did identify an uncorrected material misstatement of the other information, they are required to describe it in this section.
so it's a heads up to the reader. We read this, we didn't audit it, but here's something you should know about it if we found an issue.
That's a perfect summary. And for issuers, the public companies, they might use a similar approach or sometimes include an explanatory paragraph making similar points, disclaiming an opinion.
Okay, that covers other information. Let's shift gears now. You mentioned another category, supplementary information. How is this different? It sounds, well, supplementary.
It is different, and the key difference lies in the auditor's level of involvement. Supplementary information, like other information, is presented outside the basic financial statements. It could be in the same annual report or even a separate document.
Right.
But auditors can be specifically engaged to report on this supplementary information. That engagement changes everything. It means the company is asking the auditor to do more than just read it. They want the auditor to perform procedures and provide some level of assurance on it.
Ah, okay. So it's not just a passive read-through, it's an active engagement. What are the auditor's main goals when they take on that kind of engagement?
There are two core objectives. First, to evaluate the presentation of the supplementary information in relation to the financial statements as a whole. Does it look right? Is it presented fairly alongside the main statements?
And the second?
The second, and this is key, is to report on whether that supplementary information is fairly stated in all material respects,
Yes.
again, in relation to the financial statements as a whole.
Fairly stated. That sounds like audit language. It implies a higher level of assurance than just reading for inconsistencies.
Much higher. It means the auditor has performed specific procedures on that supplementary information to be able to make that statement.
Okay, so if an auditor is going to stick their neck out and give an opinion that this extra information is fairly stated, there must be some ground rules, right? Some
Right.
conditions that have to be met first.
Absolutely. They can't just offer an opinion on any old information. There are 5 specific conditions that must be met before they can issue an opinion on supplementary information.
Let's hear them.
Okay. 1. The supplementary information has to be derived from or relate directly to the underlying accounting records used to prepare the main financial statements. Can't be totally disconnected.
Makes sense. What's 2?
2. It has to relate to the same period as the audited financial statements. You can't audit 2023 financials and then give an opinion on 2024 supplementary data in the same report.
Got it. Same time frame. Number 3.
3. The financial statements themselves had to be audited, and the auditor has already issued their report on them.
Obvious but necessary. Number 4.
4 is critical. The auditor must not have issued an adverse opinion or a disclaimer of opinion on the main financial statements.
So if the main financials are fundamentally flawed or couldn't be audited, you can't then turn around and give assurance on related supplementary info.
Exactly. The foundation has to be solid. And finally, 5. The supplementary information will either accompany the audited financial statements, like in the same binder, or the audited financial statements will be made readily available to anyone who gets the supplementary info.
Okay, those 5 conditions make a lot of sense. It seems like management has a big role to play here too, not just the auditor.
They certainly do. Management has clear responsibilities when it comes to supplementary information that an auditor is engaged on.
Such as?
Well, first, they have to actually prepare the supplementary information according to whatever criteria apply, maybe GAAP, maybe something else. They also have to provide the auditor with written representations about it, basically signing off on certain facts.
Okay, written proof.
Yes. And they must include the auditor's report on the supplementary information in any document that contains that information and indicates that the auditor reported on it.
So they can't just publish the supplementary info and mention the auditor reported on it without actually including the auditor's report itself.
Correct. And finally, they need to present the supplementary information with the audited financial statements or make those statements readily available, tying back to that 5th condition for the auditor.
Right. So let's get into the nitty-gritty. If an auditor is engaged to report on supplementary information, what procedures do they actually perform? What work are they doing?
They perform procedures that are specifically designed to see if that information is fairly stated. And importantly, they use the same materiality level they used when auditing the main financial statements.
So the threshold for what's considered a significant error is the same for both the main statements and this supplementary info.
Exactly. The procedures typically involve things like inquiring with management about the purpose of the information and the criteria used to prepare it, determining if it actually complies with those criteria in its form and content.
Checking the presentation.
Right. Understanding the methods management used to prepare it and whether those methods changed from prior periods. Comparing and reconciling the supplementary information back to the audited financial statements and the underlying accounting records.
So tracing the numbers back.
Yes, tracing it back. Also, inquiring about any significant assumptions management made in preparing it. Evaluating the overall appropriateness and completeness of the information. And, as mentioned, getting those written representations from management.
That sounds pretty thorough. Much more than just reading.
Oh, absolutely. It's a significant level of work. One quick note, though. Auditors generally don't have a responsibility to look for things happening after the balance sheet date, subsequent events, specifically for the supplementary info, unless that's part of the specific engagement.
And I recall for public companies, the PCAOB adds even more requirements, like specifically evaluating the methods used and ensuring reconciliation.
That's right. The PCAOB standards often add layers of specificity for issuer audits.
Okay, so after doing all that work, how does the auditor report their findings on this supplementary information, assuming it's a non-issuer again?
They have 2 options for reporting. They can include a separate section within the main auditor's report on the financial statements, right after the opinion paragraph usually, or they can issue a completely separate report just on the supplementary information.
And what's the key message in that report or section?
The key message is their opinion. They'll typically state whether the supplementary information is fairly stated in all material respects in relation to the financial statements as a whole. That's the phrase that signals they've done the work and are providing assurance.
Okay. But what if, after all those procedures, they find a material misstatement in the supplementary information, and management, again, refuses to fix it?
Well, since they were engaged to give an opinion, they can't just describe the problem like they might with other information. They have to modify their opinion on the supplementary information.
So a qualified or adverse opinion, but just on the supplementary part.
Exactly. They'd issue a qualified or adverse opinion specifically on the supplementary information and describe the misstatement causing it. If they were planning to issue a separate report, they might just withhold that report entirely.
This brings up a really important connection. How does the opinion on the main financial statements affect the opinion on the supplementary information?
It's a direct link.
Okay.
If the auditor issued a qualified opinion on the main financial statements, and the reason for that qualification also affects the supplementary information, then the opinion on the supplementary information must also be qualified.
Okay, the qualification flows through.
It flows through. But here's the really critical rule. If the auditor issued an adverse opinion or a disclaimer of opinion on the main financial statements,
Uh-oh.
then they are flat out prohibited from expressing any opinion on the supplementary information. Full stop.
Wow. So if the main financials are deemed misleading or unauditable, you simply cannot give any assurance on the related supplementary data.
Correct. You can't build a reliable extension onto an unreliable foundation.
Makes perfect sense. And I assume issuers have similar reporting rules, maybe an explanatory paragraph or separate report, and the same core principles about adverse or disclaimers on the main statements, preventing an opinion on the supplementary.
Yes, the principles are broadly similar for issuers under PCAOB standards, with specific formatting and dating requirements.
Okay, deep breath.
Hmm.
We've covered other information, supplementary information. There's one more category, isn't there? Required supplementary information.
That's the last piece of the puzzle. Required supplementary information, or RSI.
What makes RSI different from the other two? The name implies it's mandatory.
It is mandatory, but mandatory according to a designated accounting standard setter, like FASB or GASB. Think of things like management's discussion and analysis, MD&A, required by the SEC for public companies, or certain pension information.
So it's required by the rule makers. But what's the auditor's role? Is it like other information or supplementary information?
It's actually closer to other information in terms of the auditor's opinion. Generally, the auditor's opinion on the main financial statements does not cover the RSI. Even though it's required, they aren't typically engaged to audit it or give an opinion on whether it's fairly stated.
Okay, so no opinion, similar to other information. But are the procedures the same, just reading it?
Slightly more involved than just reading other information, but still very limited compared to auditing supplementary information. The auditor performs specific limited procedures on RSI.
What kind of limited procedures?
They need to inquire with management about how the RSI was prepared, the methods, any changes in methods, significant assumptions used.
Okay, ask questions.
Right. They also need to compare the RSI for consistency with management's answers to those questions, with the audited financial statements themselves, and with any other knowledge the auditor picked up during the main audit.
So check for internal consistency and consistency with the audit.
Exactly. And finally, they need to get written representations from management stating that they are responsible for the RSI.
What if they run into trouble doing these procedures, like management isn't cooperating?
If management prevents them from completing these limited procedures, the auditor has to communicate that limitation to those charged with governance.
Okay. And how does this get reflected in the auditor's report for, say, a non-issuer?
Similar to other information, there's usually a separate section in the audit report dedicated to RSI. This section doesn't give an opinion, but it does describe certain circumstances if they exist.
Like what?
Like whether the RSI is included and whether the auditor was able to perform those limited procedures. It would also explicitly state if the RSI is omitted entirely when it should be there.
Oh, so they call out missing information.
Yes. Or if there are material departures from the official guidelines on how the RSI should be presented. Or if the auditor couldn't complete the required limited procedures, or if they have unresolved doubts about whether the RSI conforms to the guidelines.
And it reiterates that management is responsible and the auditor gives no opinion.
Absolutely. It makes that very clear. And if there are material departures from the guidelines that management refuses to correct, the auditor describes those departures in this section.
And for issuers, Under PCAOB rules, it's slightly different. Maybe no separate section unless there's a problem.
Generally, yes. For issuers, an explanatory paragraph usually isn't needed unless there's an issue like the RSI being omitted, material departures identified, the procedures couldn't be completed, or there are those unresolved doubts.
Got it. One final point on RSI. Even though auditors aren't required to audit it or give an opinion, could a company ask them to?
Yes, they could. A company can choose to engage their auditor to perform a full examination or review engagement on the RSI and issue a separate opinion on whether it's fairly stated. That's above and beyond the basic requirements, though.
Okay, wow. That was quite a journey through the extra information landscape.
It really covers a lot of ground.
So just to recap quickly for everyone listening, we looked at 3 key types of information you might find alongside audited financials. Other information, which auditors read for inconsistencies but don't opine on.
Right. Then, supplementary information, which auditors can be engaged to audit and provide an opinion on, but only if certain conditions are met.
And finally, required supplementary information, which is mandated by standard setters, gets limited procedures but no opinion unless there's a specific problem or a separate engagement.
Exactly. The level of auditor scrutiny varies significantly between these 3.
Understanding these differences, it really gives you a much sharper lens for reading an annual report. You know what's been deeply audited, what's been read for consistency, and what's had some limited procedures applied. It's not all the same.
It absolutely isn't, and it leads to a final thought. The next time you pick up an annual report, don't just look at the bottom line numbers in the audited statements. Pay attention to that surrounding information, the MD&A, the supplementary schedules, and consider the auditor's report carefully. Knowing the different levels of assurance attached to different pieces of information is crucial. So maybe ask yourself, how does knowing that the auditor's involvement varies across these sections impact how much weight you give to, say, the management's narrative versus a supplementary financial schedule?
That is a fantastic question to reflect on. It really highlights that being an informed reader means understanding the context and the verification behind the words and numbers.
It's about critical consumption of information.
Well, thank you so much for guiding us through that complex terrain today, and thank you for joining us on this deep dive. We hope it sheds some light on those often overlooked parts of financial reporting. Until next time, keep digging deeper.